We mentioned the hunt for yield. There's always a hunt for yield out here on Wall Street. Investors' hunger for income put dividend ETFs front and center right now. So back over to you, Todd. You're really flagging an important distinction when it comes to choosing the right dividend ETF. Can you just kind of break down what people should be looking for?
Sure. So we at CFRA view things from a dividend growth perspective and a dividend yield perspective. So ETFs tend to be focused on how the company pays a dividend and how that yield is part of the portfolio. So dividend growth ETFs are more forward-looking. These are companies with either earnings power to have historically paid a dividend or the earnings power to continue to grow and raise that dividend, as opposed to the more defensive-laden dividend yield ETFs. So ETFs such as NOBL, which is a ProShares ETF, or SDY, which is a SPDR ETF, those look backward at the last 20 or 25 years of companies raising dividends. An ETF like DGRW is a wisdom tree ETF, is actually more of a projection. That DGRW ETF has more tech exposure than those two other ones. As we touched on, tech is growing, but also the dividend base is growing. And what's exciting is that we finally saw investors return to dividend ETFs. They've been out of favor for the first half of 2020. In July, there were net inflows to these ETFs, probably because companies stopped cutting the dividend the way that they had been since the pandemic first emerged.
Well, Todd, we were actually speaking earlier, and you said to me, history is just that, it's history. If that ETF, the one you mentioned, the NOBL, looks back with so much uncertainty, can investors feel a lot of confidence that they're putting their money into an ETF that will continue to see those dividends?
But we at CFRA are big believers that you need to look inside the portfolio and look forward to what's inside. So just because the company has paid dividends for the last 20, 25 years, it doesn't mean it will continue to do so. And so there have been companies that were part of that Dividend Aristocrats ETF that were removed because they cut the dividend. But thankfully, the vast majority of the companies that have a long history have continued to do so. But certain sectors of the economy, specifically energy and consumer discretionary, has been hard hit in 2020. Those kind of companies have been cutting or suspending the dividend, and that's not a good sign for investors.
Absolutely not. Jay, over to you. Global X, they have a few dividend ETFs of their own. You guys have a few, including a super dividend ETF. What's your take on all this hunt for yield?
Well, you have two things happening right now. Is you have no yield out there. The Federal Reserve has lowered the federal funds rate to zero, and corporate spreads are trading very tightly. So just looking at bonds is giving investors very little yield. And then on top of that, you have the retiring baby boomer generation that is looking to transition their portfolios from more of a growth focus to an income focus. And when you combine those two things, it puts a huge emphasis on trying to find a yield in more narrowly sliced corners of the market. We think equities are a great place to find it, whether it's high dividend payers. We think there's certain strategies that can generate very significant yield, like covered call strategies, which buy stocks and sell call options on top of it. And then lastly, the area that we're very bullish on right now is preferred stocks, which have kind of a middle place between bonds and equities. They pay pretty high yields, and these are largely U.S.-based financial firms that are showing pretty strong strength in this environment right now.